Hey everyone, and welcome to this explainer. I'm honestly so pumped to get into today's topic with you. We're going to unpack a super high-level strategy to completely bypass the massive headaches of institutional lending. Basically, we're looking at exactly how you can rapidly scale your commercial real estate portfolio. So if you've ever felt, totally bottlenecked by the bank, or if you just want a much more capital-efficient way to grow, well, you are absolutely in the right place. Let's jump right in. Okay, I want you to picture this for a second. Imagine you found it, the absolute perfect distressed asset. It has massive potential, great bones, and you know exactly how to turn it around. But then, boom, a huge roadblock. You're suddenly staring down the barrel of multi-month approval cycles, endless paperwork, and these incredibly strict lenders who threaten to kill the whole deal before it even gets off the ground. It's a literal administrative gauntlet, right? So, how exactly do you take control of a $5 million property when traditional bank underwriting just completely refuses to play ball?
Well, to answer that, we'll break this strategy down into 4 actionable phases. Number 1, the institutional gauntlet. Number 2, Phase 1, agreement setup. Number 3, Phase 2, operational turnaround. And finally, Number 4, the Year 3 exit.
All right, let's start right off with part 1, the institutional gauntlet.
The secret sauce here is a concept called decoupling. It's kind of like separating the keys to the building from the actual deed itself. To completely bypass those deal-killing approval cycles, really sophisticated investors are decoupling asset control from immediate ownership. And they do this by leveraging Master Lease Agreements, or MLAs, coupled with an option to purchase. So instead of fighting tooth and nail for some expensive new loan to buy an underperforming property outright, this strategy lets you step directly into a pre-existing financial structure. You're taking the property completely outside of the traditional banking architecture and just getting straight to work.
Which brings us to Part 2, Phase 1, Agreement Setup. To actually make this work, the lease agreement setup requires you to divide the transaction into 2 distinct, simultaneous legal instruments. First up, you've got an absolute NNN, or triple net master lease. This means you take on the operational costs, taxes, and insurance. Then, second, you have a totally separate option to purchase contract. When you put these 2 together, they give you total, unhindered operational management of the property today, while, and this is absolutely key, securely locking in a firm future purchase price for tomorrow. Now, the really crucial point here is how the money flows. As the operator, you pay a fixed monthly lease. Ideally, this is meticulously scaled to perfectly mimic the current owner's ongoing costs. Their principal, their interest, property taxes, insurance, the whole shebang. You cover their carrying costs completely. But here's the magic. Because you are the master tenant running the property, you retain absolutely every single dollar of operational upside and rental revenue from day one. You do the hard work, you keep the reward.
And just look at the dramatic capital efficiency here. Let's run some numbers. Say you've got a $5 million distressed asset that needs, let's say, a $750,000 renovation. If you go the traditional bank bridge loan route, you're looking at needing roughly $2.15 million in total upfront cash between your down payment and reserves. But look at the MLA route. That initial cash outlay drops to just $875,000. I mean, that is a staggering difference in how much capital you need to bring to the table just to get the keys.
By simply avoiding the bank and utilizing that master lease agreement structure, you save over $1.2 million in immediate liquidity. You're keeping your upfront capital footprint incredibly lean, and that frees up your cash to actually deploy into the physical property renovations instead of just locking it away in some bank vault.
Moving right along to Part 3, Phase 2, Operational Turnaround.
So this strategy is incredibly effective for what we'd call unbankable distressed assets. These are properties where the current cash flow is just so terrible it absolutely can't justify standard bank financing. But because you're operating outside the bank, without that crushing burden of high-interest bridge debt or stressing your own personal balance sheet, you actually have serious breathing room. You can dive in and execute aggressive operational turnaround tactics. You get in there, knock out your capital expenditures to modernize the units, revitalize the whole property, systematically lift that net operating income, and literally force real, tangible appreciation.
And that leads us to our final phase, Part 4, the Year 3 exit.
Let's run a hypothetical scenario based on the data. Let's say you successfully execute your turnaround tactics over a few years. You take this distressed property that's generating a pretty meager $200,000 in net operating income. Through your hard work, you lift it to a stabilized $520,000 NOI.
Now, at a 6.5% cap rate, which is the expected rate of return on the property's income, that NOI lift pushes the asset's overall valuation all the way up to $8 million.
But remember phase one? Remember the lease agreement setup? This is exactly why setting that up with such precision was absolutely vital. Your option contract already locked your purchase strike price at that original $5 million floor. So the property is now objectively worth $8 million on the open market, but you hold the exclusive legal right to buy it for just $5 million.
Just think about what that actually means. Because you decoupled control from ownership at the very beginning of the timeline, before you even sit down at the table to close the final purchase, you instantly walk into $3 million of immediate, forced equity. You created that immense value, and your legal structure ensured you captured every single penny of it.
And the benefits honestly don't even stop at the equity. When you finally do go to an institutional bank to exercise your purchase option and officially buy the property, the conversation is completely different than it would have been back in year one. You're no longer presenting a risky, unbankable turnaround project that they're just going to reject. No. You're presenting a stabilized, completely de-risked asset boasting a highly bankable 2.3x debt service coverage ratio. That means the property generates more than double the income needed to pay its debt. The bank is literally going to roll out the red carpet for this loan.
And this brilliantly illustrates the ultimate payoff of everything we've talked about in this explainer. That extreme structural leverage, keeping your capital footprint super lean while capturing all the upside, it jumps your final multiple on invested capital, meaning the total cash you get back versus what you originally put in. A traditional financing route would have yielded a very respectable 1.98x multiple, but the MLA route, it absolutely rockets your MOIC to a massive 3.42x. Ultimately, a master lease agreement lets you treat a property turnaround a lot like an options trade in the stock market. You get to completely prove out the business concept, physically de-risk the asset, and force appreciation entirely on your own terms. And you do all of this long before you ever have to step onto the institutional balance sheet ledger. As the numbers clearly show us, controlling an asset is often significantly more profitable than owning it right away under strict bank constraints.
As we wrap up this explainer, I really want to leave you with a fundamental question. It's a total paradigm shift that should really challenge how you approach your very next commercial deal. When you look at the market tomorrow, ask yourself, are you stubbornly focused on just owning assets, or are you focused on profitably controlling them? Because the difference, as we've seen today, can literally be measured in millions. Thanks so much for joining me on this deep dive. Keep learning, and I'll see you in the next explainer.